The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Optimism around AI confronts skepticism around the economy. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. Let's get to the weekend. You can see we're fading a bit when it comes to the S&P 500. We were higher by about 0.5% earlier in the day. This would be a record high. All we need is for the color to stay green. You can see, though, that big tech is a weight on this market as measured in the NASDAQ 100, currently down about 0.4%. You can see that bonds aren't catching a haven bid right now. 10-year Treasury yields higher by about 3 basis points. We are back above 4.10 when it comes to the 10-year yield. But small caps breaking away, Romaine. The Russell 2000 up about 0.75%.
Yeah, I really love that movie, by the way. Small caps certainly are finally joining into the record rally with the Russell 2000 pushing higher on the back of quantum computing and AI-adjacent energy stocks. This after reports that BlackRock's global infrastructure partners may actually acquire Aligned data centers for $40 billion. That's going to add to the parade of eye-popping deals that we've seen in this space, one that continues to support equity markets. And keep in mind that AI spend not just supportive of markets, but also the main pillar of support for the economy, particularly given today's data that showed business activity in the U.S. services sector shrinking for the first time since the pandemic. That joins the manufacturing sector, which more or less has been in contraction now for 3 years running. Goldman CEO David Solomon, he pointed this out, saying government spending and the AI build is on balance, while the economy is still in good shape.
But I'm optimistic that we're probably going to see an acceleration as we continue to head into 2026. The big structural issue that's kept the U.S. economy going so well is the U.S., and by the way, other developed economies around the world, are running very aggressive fiscal stimulus plays. Governments are spending enormously into economies in the developed world, and that keeps the economy going even when you have other headwinds.
And of course, as investors remain transfixed by AI, they're still keeping an eye on the rally in gold, the 7th weekly advance setting up here as the U.S. government shutdown clouds signals on the Fed's rate cut path. Dallas Fed President Lori Logan, Chicago Fed President Austin Goolsbee, even Fed Vice Chair Philip Jefferson, each today reiterating words of caution for proceeding with the easing, given inflation is still above their target.
And I guess we're going to have to take their word for it, given that we're getting no official government data as that shutdown continues. But let's take stock of this market. You have the S&P 500 in white here, and then you have the percent of those members above their 20-day moving average. As that white line goes higher, you can see breadth has been breaking down a little bit. Currently, just above 55% of S&P 500 members are trading above that 20-day moving average. But consider where we've been, Romaine, in May, then in July, and then in August. As recently as August, that number was closer to 80%. So these incremental gains that we're seeing pushing us to those record highs one after another is being driven by increasingly a lower number of those names.
All right, well, let's kick things off to the close here on this Friday afternoon with Mona Mahajan, head of investment strategy over at Edward Jones, and she joins us here in Studio 2. Great to see you.
Thank you, Romaine. Great to be here.
Hey, look, I mean, you've seen the run-up, and you know all the discussion right now about what's driving it or maybe what's not driving it. I guess the big question that everyone has right now is, do you see enough evidence that there is enough conviction behind some of these trades that this will keep going, in the foreseeable future?
Yeah, look, we've been up 35% now in the S&P 500 without a 5% correction since the April lows. So could we see some period where the investors have to digest some of these gains or at least look for reasons to take profit? And keep in mind, we're in October. We have a shutdown upon us. We're in a little bit of a lull in data ahead of Q3 earnings season. There are reasons where investors may pull back, for investors to pull back. But do we see that pullback morphing into a deeper, prolonged bear market? That's where we say probably not. That usually happens when you're entering recession or the Fed is raising rates aggressively. Neither of those are on the table for us, and we do see some optimism heading into 2026.
When you look at the complexion of this rally, does it feel narrow to you?
You know, thus far, it's been the third year in a row where this rally has been driven, and certainly this recovery post-April has been driven by tech AI growth sectors. We are in a period now where the Fed is once again embarking on a rate cutting cycle. We could see cyclical upturn next year when the tax bill kicks in as well. Could we see some scope for broadening? Absolutely. But really, it's going to be the earnings growth that drives, we think, the underlying market growth. And thus far, earnings have been driven by tech and AI.
When I think about breadth, I think of it basically as a nice to have. You don't need to have it to hit all-time highs, but I want to bring that thought to the Federal Reserve. The next meeting is on October 29th. We could enter into a situation where the government is still shut down by then, where we don't get any economic data releases from the government between now and that meeting. Does the Fed need official data in order to cut?
Yeah, it's an interesting question. So one, official data is nice to have. It gives you a little bit more transparency on the economy. There are alternative sets of data. We saw the ADP private payrolls report. The Chicago Fed has some labor statistics. But these are alternative data for a reason. They're not as comprehensive or built out. Now, all that being said, we know the Fed was on a path. The September dots told us that they wanted to get towards a neutral rate over the next 12 months. We think they'll continue in that direction. And interestingly, this week, even post-shutdown, the probability of a Fed rate cut in October has actually moved substantially higher, perhaps because the economy may slow a bit and we may get some layoffs through this shutdown as well.
I'm curious how, as an investor, you are looking at this period of time, because the narrative that Romaine and I keep hearing from a lot of different types of folks is that this doesn't really matter for markets. What's going on in D.C. when it comes to the shutdown, it's a little bit of a sideshow when you think about the things that you mentioned, such as corporate fundamentals and what's actually going on in the economy. But if this drags into weeks, if we do get to that Fed meeting with the government still shut down, is that when it starts to bite a little bit?
You know, I think it could bite more. When we look back at the last long government shutdown, which I think was back in 2018 when we were 35 days or so, the CBO estimated that that cut 0.4 percentage points off of quarterly GDP. The good news this time around is Atlanta GDP Fed was pointing to a 3.8% GDP growth rate for the third quarter. So even if you cut half a percentage point off of that, not ideal, might stall the momentum a bit, but you're still looking at an above trend growth rate for the economy. So good to see we're coming in from a position of strength.
I'm curious as to what you're hearing from clients over at Edward Jones with regards to how they feel about the current state of markets. Is it sort of the FOMO where they're just looking to get in and chase this rally? Are they expressing concerns about the economy? What?
Yeah, you know, look, one of the things that we talk about with our clients, one, don't play politics with your portfolio. We know that long-term investors are rewarded for time in the market. We always say time in the market better than trying to time yourself in and out of the market. If you do try to time yourself out, you have two decisions to make: when to get out, when to get back in, and sometimes along the way you miss some of the best days. But what we will say is, while this shutdown news hasn't caused market turmoil per se, it has caused a lot of headline swirl. The uncertainty does increase with clients, and they have questions. And this is a great way for our advisors and our teams to make sure that they don't make those emotionally charged investment decisions, and hopefully can maintain their strategic allocations for the long term.
I do just want to look a little bit further ahead into next year, because there's been a lot of discussion about how corporate earnings have held up. The AI spend has been a big pillar of this economy, and presumably we're, even if not in it already, at the start of a rate cutting cycle here. Do those end up being short-term drivers, or do you think that longer term, structurally, that is the market?
Yeah, absolutely. And look, I think there is a cyclical element to this. Fed rate cutting cycles are cyclical. They tend to cut rates when they want to move towards a neutral environment if the economy is, holding up. And the AI theme, we think, is more of a secular theme. So there's a structural shift there. That one is going to have some legs. If you compare it to the 1990s, we're maybe in the second or third inning, maybe a little bit further this cycle, but nonetheless, there's some room to grow. We do think over time, of course, it'll be the AI, infrastructure, semiconductor type players, but ultimately we want to get to a point where the sectors are benefiting: healthcare, financials, industrials, et cetera, et cetera.
All right, Mona, always a pleasure.
Great to be here.
Mona Mahajan, head of investment strategy at Edward Jones, kicking us off to the close here on this Friday, a Friday where we were supposed to get that jobs report from the U.S. government. That's on hold, and so too is Washington. A conversation up ahead with the head of the Society of Human Resource Management, Johnny Taylor, is going to be joining us to talk about how his clients are facing the shutdown.
And from hiring freezes to health fixes, Novo Nordisk President Dave Moore joins us on what's next for Big Pharma and the red-hot GLP-1 industry.
And just before the show started, Katie was listening intently to Life of a Showgirl, a conversation about the economic impact of Taylor Swift's new album release and the accompanying movie with the author and professor, Misty Heggeness. Stick with us. This is The Close on Bloomberg.
Well, despite the government shutdown delaying the jobs report, various readings from previously released data or data from outside the government show signs that the September payrolls number could be in the mid-50s to low 60,000s whenever we do get it. But questions about the labor market have only been heightened by President Trump's threat to fire federal workers. Here with the broader picture is Johnny C. Taylor Jr. He is president and CEO of the Society for Human Resource Management. Johnny, it's great to have you with us. And that's a different wrinkle to this shutdown. We're not just talking about furloughs. We're talking potentially about mass layoffs. What has that meant for you and what the past 72 hours have looked like?
Gosh, first of all, just anxiety. I mean, we were already struggling. We went through the early months of the year with the DOGE actions. And so employees, particularly in the D.C. market, but frankly, all over the country where there are federal workers in jobs, it's begun to create a lot of anxiety for the workplace. And private employers, though, are looking at this, frankly, there's some upside in this. They're saying there may be opportunities because very talented people now are available, and we are using this as an opportunity to go shopping, if you will.
That's interesting to hear. And I remember, when we were seeing really large layoffs from big tech a couple years ago, there was that conversation that those workers can be easily absorbed elsewhere. But when it comes to federal workers, as you said, there's private employers who are looking at this as an opportunity. But just the scale of layoffs that we're talking about, is there enough demand from those private employers to absorb that?
That's the problem. Is back then, you're right, when big tech was laying off, we had 2.5%, 3% unemployment in some states like Iowa, sub 1%. There were more jobs than there were people. And now we don't have that. In fact, for the first time since like early 2018, the market says we have more open jobs, more people looking for jobs than open jobs, and that has really reversed it. But that doesn't mean there's always an opportunity and opportunities for people who are talented. So we private employers are looking at these folks and saying, if you have the skills that we need, we'd love to talk with you.
I am curious, Johnny, just about some of the longer term implications here, because, I mean, you kind of started off about DOGE and whatever happens with this shutdown. We do know the administration, at least publicly, has made it clear that they do want to take advantage of this to maybe trim the federal government back even more. There's certainly a longer term trajectory here that seems to be a slimmer government, at least in terms of headcount, not just in terms of those employed directly by the government, but also on the contracting side as well. Is that something that everyone is prepared for?
As prepared as one can be. At this point, it's creating a lot of anxiety. As I said, call it a year or two ago when we had 2-3% unemployment. Now that we're in the mid-4s, it's a very different game, and that's creating real problems. We're seeing, for example, with the quit rate, employees are staying in their jobs longer. They're less likely to move around. So it is going to be a tough time for those who are seeking jobs right now.
I also just want to get your thoughts on the impact of technology. There's been a lot of talk about the use of artificial intelligence and related technology tools for companies to better manage their companies. And of course, one of the areas that has been targeted almost initially has been in the Human Resources Department, where a lot of people look at some of those human jobs and say that there's a lot that's going on here that can be automated. How are your folks dealing with that?
Boy, all we talk about is anxiety. There's no question that we are seeing the HR profession in particular contract. And that's because much of what we used to do, let's face it, the machines are doing. Now, that doesn't mean it's not going to free us up to do higher level strategic value added work. But for people who weren't doing that, who were doing things that are automatable, their jobs are at risk. And we're quickly trying to retrain those professionals so that they can do other things in the new economy.
And when it comes, to the new economy, I just want to bring it back to the shutdown because, as we've discussed and as you point out in your notes, 72 hours is still too early to see the impact. But you layer on some of those forces you talk about with the uncertainty that we're experiencing right now. At what point do we start to see the impacts from what we're seeing down in D.C. right now?
Yeah, from our past experiences with shutdowns, about 8 days. 8 days is when people begin to miss that paycheck. And, we're just 72 hours in, but push this out a week when people were expected to be paid, and not just be paid, not just individuals who work for the government, but those who are contractors of the government and their employers, not the federal government, their employers were expecting to be paid. We're going to start seeing people miss a paycheck, which means they will miss paying their bills. It may be the mortgage, the light bill, et cetera. That's when we're going to see this. The roosters are going to come home, right? The hens are coming home to roost. So about a week from now, we're going to know a lot more.
All right, Johnny, I have to leave it there. Really appreciate you taking time for us. Johnny C. Taylor Jr. is the president and CEO over at the Society of Human Resource Managers. As we continue to count you down to the closing bells here on this Friday afternoon, we continue to focus on Washington, the labor market, the economy, and maybe potentially the government's credit rating. We're going to take a deeper dive into the implications of the shutdown with a managing director over at S&P Global Sovereign Ratings. That's coming up next here on The Close. This is Bloomberg. Here on day 3 of the U.S. government shutdown, and S&P Global is out with new analysis this week stating that the U.S. government shutdown is adding to uncertainty to the economic outlook. The report says the shutdown itself will only have a marginal effect on the broader economy and isn't considered a credit event, but there are secondary effects out there that could add up over time. Lisa Schineller joins us right now, Managing Director at S&P Global Sovereign Ratings. Talk a little bit more about this. Lisa, great to have you here.
Thank you. It's a real pleasure.
I'm going to go right to the bottom of that.
Yep.
That's really about kind of these second-tier effects and whether they add up. I understand that, at least as it stands right now, this is not a credit event. In the past, most shutdowns have not been credit events.
No shutdown has been a credit event from our point of view for the sovereign rating.
Great point. What, if at all, could be different about this time with regards to the potential for any sort of economic damage, not necessarily credit damage, but economic damage?
So the shutdown itself, we're talking about funding and resolving funding for fiscal year 26. So that will need a combination of 12 appropriation bills, a CR, a mix, passed on a bipartisan basis in the Senate. So this is where the challenge comes in to fund the fiscal year. That in and of itself, past shutdowns, they've always been resolved. Some have been longer, some have been shorter. And as you noted, the length of a shutdown can impact what is the depth of the secondary impacts, right? And our economics team does that. What is, I would argue, separate from the shutdown, that's an important point to highlight. I know there is conversation about a reduction in force initiative, which is not clear, right? But that should be viewed separate from the shutdown itself because that's a different initiative. In general, some of the policy changes that are underway, from our economics team's perspective, that has put somewhat more uncertainty on the investment dynamic. That said, the growth story has remained very solid.
Yeah. When you're looking at the sovereign rating, particularly for the world's largest economy,
yep.
How much of it is just a straight, can we pay our bills? How much of it is the uncertainty coming out of Washington, the fact that we've gone 20 plus years now without passing a budget on time? How much of it is it about the changes, let's say, in our political climate that has some people worried economically?
So, from the sovereign rating perspective, I'd say the key weakness in the story is the fiscal path, the trajectory, the size of the deficits, and that's what we've highlighted. If you're thinking about the economy, the economic strength is, up there, right?
Yeah.
We're talking about 89,000 per capita GDP, and while we do expect a slowing in growth last several years to this year, we still have a pretty strong rate of growth. If you're stepping back and thinking of an 89,000 per capita GDP economy, the depth, the resiliency, et cetera, and vis-a-vis other peers, and all of this, of course, is within the tone of our methodology. So we have that key anchor. While on the margin, the growth can slow, and there's not saying there's not an economic impact, so I want to make that clear. But from the rating, you still have a lot of depth there, and that is a lot of support, along with other factors in our assessment, aspects of institutionality, the Federal Reserve independence, et cetera, role of the dollar that support the ability to pay debt. And on your point, the credit rating is just that, ability and willingness to pay debt on time and in full.
Well, I like that point you make about the depth. That's an interesting way to phrase it. And you point out in your notes that you're really focused on tariffs and tax cuts as a team right now. And I know that last month, or 2 months ago now, back in August, you put out a report that said basically the tariff revenue is helping to offset some of the effects of the tax cuts when you think about that rating that you have on the U.S. Now, fast forward, we are in October officially. I mean, has your assessment of that situation changed? Does the shutdown impact that view at all?
No, the shutdown does not impact that view. Start with that. The assessment hasn't changed. We haven't changed the rating or the stable outlook. So quick answer there. And I think the nuance that I would add is that the One Big Beautiful Bill Act budgetary legislation isn't necessarily even fully in force yet, right? And the tariff panorama is evolving, right? I think that's the other thing. And we understood that at the time, but 7 months in at the time, we believe it's pretty clear there's a definitive commitment to an important increase in the effective tariff rate, and that would bring with it meaningful tariff revenue. That exact contour is still evolving in terms of the question of IEEPA, and then how that would be offset, which we believe there are mechanisms to do that. But there are all new tariff agreements coming, some exemptions, some new higher tariffs. So all in, what we believe looking forward is that we have to see execution under the budgetary legislation. We'll see how the tariff revenue plays out. We'll see if there are other secondary effects from tariffs on other dynamics within the economy. We're assuming the resiliency in the revenue base. But at the end of the day, it's the outcomes on the fiscal side, and how that path evolves is the key thing. At this moment, and what we've putting out in August, we can't say the deficit path is meaningfully worse.
Right.
We also don't think it's meaningfully better, right? But and it stays high, right? And debt continues to edge somewhat higher.
Right. Lisa, it's great to get some time with you. Really appreciate you stopping by. That is Lisa Schineller. She is Managing Director over at S&P Global Sovereign Ratings. Meanwhile, you take a look at these markets right now. We're still looking at a weekly gain, but those gains fading a little bit on the S&P 500 with 30 minutes to go into those closing bells. And coming up next, with GLP-1s continuing to be a red-hot market for Big Pharma, we'll discuss what's next for one of its biggest producers with Novo Nordisk President Dave Moore. That conversation up next. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. We're trying to hang on to gains on the S&P 500 heading into this close on this Friday. It's been a long week, Romaine.
It's been a long week, but you're talking about stocks still cranking out record highs, the S&P up fractionally. And what's leading the charge today, not necessarily big tech, but you're seeing a lot of healthcare names at the top of the board. You had some relatively encouraging news when it comes to Medicare reimbursement, U.S. government Medicare reimbursement. That's pushing the health insurers higher. And you're also seeing a lot of drug makers move as well.
Big time, especially considering as we continue to digest that pharma news with Pfizer and the Trump administration earlier in the week. And with that in mind, it's been a big week for healthcare, mostly thanks to those big pharma names. That news that Pfizer has made a drug price deal with the Trump administration sent shares in the space soaring, with competitor Novo Nordisk also seeing big gains this week. Earlier today, Romaine and I sat down with Novo Nordisk President Dave Moore to discuss the sector as a whole, the GLP-1 outlook, and if he thinks Novo could make a deal with the Trump administration too. Take a listen.
We are in conversations with the administration, and I would say that there's some like-mindedness there with our organization as well, which is we think increasing the affordability and the access to medicines is a really positive thing. And we want to engage in any conversations that can lead to more medicines having access to our products like Wegovy and Ozempic.
I would love if you could bring us into those conversations a little bit. You know, what the mood music is about, you know, when it comes to manufacturing. You have a big U.S. presence, but when it comes to pricing as well, what those discussions have started to sound like.
Well, the discussions are centered around affordability and access and the different channels that exist in the U.S. market, like Medicaid and Medicare and the commercial channels, and trying to find a way where we can meet patients where they are so that they can afford medicines and have readily access in a more seamless way as well, so it's easier to get their medicines.
How do you do that, though? I mean, we've seen attempts by Novo, as well as some of your peers, to, I guess, partner with some of the compounding pharmacies to find a way around the PBM structure here in the United States. What do you need to make that process a little bit more seamless as to a patient being able to get a drug either directly from you or at least in a more cost-effective manner?
Yeah, I think it's important that we look at all of the opportunities that exist, and you mentioned some of them. The first is to ensure that patients have access through their insurance. If they have insurance, that the medicine is covered. And we want to expand that. Today, there's about 55 million Americans that have access to Wegovy through their employer-sponsored insurance programs. So it's important that we increase that because there's about 110 million people in the U.S. living with obesity. Earlier today, we announced a new partnership with Costco. We're teaming up with Costco to make our medicines available at their pharmacies across the country, so patients with a prescription can just walk in and get it with a self-pay option as well.
Are you offering additional discounts or any other incentives, particularly for those folks that are paying cash and not going through their insurer?
Yeah, the discount is down to $4.99 for both Wegovy and Ozempic. And that is a discount off of the list price, less than half the price of the list. And also for people that have insurance, we obviously have a path that they have a low out-of-pocket. Most people with insurance that have coverage pay $25 or less per month for their Wegovy.
Let's talk a little bit about the form of Wegovy. We're mostly talking about injectables, but I know that you've submitted your pill to the U.S. FDA for approval for chronic weight management. What's interesting, my understanding is that you've already started production of those pills. So reading the tea leaves, it seems like you have a high degree of confidence that this will get approval.
Thanks. We're really excited, Katie. This is a transformation of obesity care, and that we can have Wegovy available in a pill. We have filed. We are anticipating approval by the end of the year and a launch in early 2026. We've been building supply in anticipation of that launch, which we think will expand the obesity market and interest for people that are not seeking care today. And Wegovy in a pill will be made end-to-end in our North Carolina plant, made for Americans by American workers in our manufacturing.
Do you think that that's the next big thing when it comes to the U.S. obesity market? The fact that you will have these medications available in a pill versus goals such as more quality weight loss when it comes to less muscle loss or just greater weight loss overall?
I think innovation continues, and it's something that we care deeply about, and we will continue all of our efforts in R&D in obesity. It's part of the purpose and mission of the company. It will include new formulations. It will include innovations with respect to magnitude of weight loss or looking at comorbidities that are associated with weight loss. And also, as you mentioned, quality of the weight loss too.
Has there been any discussion, particularly given the new CEO, about maybe potentially broadening or diversifying the product lineup over at Novo? You are pretty much an obesity and diabetes drug company right now. Any plans to go beyond that?
I think what you'll see is a maintaining the focus, and that's something that has served us well for over 100 years, is that we are a focused R&D organization. We have deep biological expertise in the areas of diabetes and obesity, and some of the associated comorbidities of diabetes and obesity, like chronic kidney disease, like cardiovascular disease. Recently, Wegovy received a new indication to treat MASH, which is a form of liver disease. So I think you'll see us continue to be focused in those areas.
What's the difference? And I know you're running the business operations here in the United States, but I'm curious if you can draw any sort of differences between what the market is like here in the United States, in North America, relative to overseas, particularly in Europe.
I think there's a lot of similarities, and one of those is that we're really just getting started if we think about obesity. and treating the people that are living with obesity. In the US, there's just a few million people that are being treated. Roughly 110 million adults are living with obesity. But then across the globe, there's close to 1 billion people living with obesity. And so we have a lot of work to do. In many ways, you could say we're just in the early stages, and we're committed to getting the medicines to more people around the globe.
A conversation we had earlier today with Dave Moore, the president who helps run the U.S. business for Novo Nordisk. And Katie, we talk about a company that has made it very clear its identity is in obesity drugs, in diabetes drug, and it really plans to push harder into that. You brought up the question that I think really lit them up, and that was about the pill. Because, I mean, right now, if you want to take these drugs, can't be squeamish. You're going to have to shoot yourself up with a needle, and some people don't want to do that.
That is for sure. And they're also hoping that this will really help give them their traction back when it comes to the U.S. market. We know that they've lost a lot of share, a lot of ground to Eli Lilly, but if they can be first to market with this pill, obviously that would give them a big competitive leg up here. Absolutely.
And we should point out Novo shares, they've been under pressure, obviously, given the CEO change and the increased competition, but trying to get their mojo back. They rallied about 6% back on Wednesday, up a couple percentage points today, setting up for one of its strongest weekly gains in quite some time. That's not the only thing that's moving. You like quantum computing?
You know, I'm told I need to really embrace the future.
Everything I know about quantum computing, I've learned over the last few months. They are the stars of the show on this Friday afternoon, and it is our stock of the hour. Coming up next here on The Close, this is Bloomberg. All right, welcome back. It's time now for our stock of the hour, and we've got a trifecta for you here on the day. Quantum computing stocks rallying, including Rigetti, QuantumScape, D-Wave, moving higher after a wave of positive news related to the space, including that news about BlackRock's global infrastructure arm potentially buying out Align data centers for $40 billion. Norah Mulinda joins us right now to talk a little bit more about some of these moves. And, you know, I was going through today some of the biggest movers. I mean, you go through the Russell 1000, and it's basically quantum computing stocks and AI energy stocks at the top of the list. What's going on?
They are doing a lot right now. I mean, if you look at the weekly scope, it's Friday. We have to look at that. Up for double-digit gains. I'm looking at Rigetti. I'm looking at D-Wave Quantum, quantum computing, all up for double-digit gains to end the week here. It's really just the broad-based AI optimism. I mean, when people are thinking about their portfolios and they want to be aggressive, they want to be ambitious and look toward the future, you start to see people go into the pockets that definitely incorporate quantum computing, and you're definitely seeing that reflected in the trade right now.
It's hard to keep up with the narrative around quantum because it feels like there's such high beta names that they can flip on a dime the sentiment depending on what Jensen Huang says about quantum. I remember he sort of flip-flopped over the summer, and that caused just huge volatility in all of these names, volatility that you're seeing once again today.
Absolutely. I mean, they are names that are extremely volatile. They are accustomed to those types of swings and dips and turns here. But I mean, if you think about a lot of the major names that we know, tried and true, Microsoft, Amazon, you're seeing a lot of them really putting emphasis and really pouring money into the space. So as you think about the future and as tech continues to evolve here, this is definitely a hot spot that you see a lot of investors keeping their eyes on.
But this is a little bit different than the rally that we're seeing in hyperscalers and some of the energy companies. We're talking about companies that basically at this point don't actually have a product or a service or revenue. I mean, the revenue for some of these companies is effectively zero, and the ones that do have revenue, we're talking in like, you know, the 7 figures, maybe into the 8 figures. This is about the promise of something in the future. And I do wonder if it's a signal that maybe, as we've heard from Jeff Bezos overnight and David Solomon and a few others, that maybe there is an AI bubble out there.
And I think that's what I've been hearing from some of my sources. I mean, those that are a bit more skeptical right now about this trade, it is the idea that there is a promise, and we're just hoping that it is delivered here. But there is no guarantee. So a lot of people are pumping money into something, essentially the unknown, if you will. And so, I mean, that is kind of underscoring this concern about whether or not we are potentially seeing some sort of bubble percolating here.
Have you ever used a quantum computer?
I have not. Have you?
No, but I'm going to stop by Best Buy after work and see if they got one.
Please do.
Out, so.
I need the reviews.
I, too, have not used a quantum computer. I wouldn't know what it looked like if you put it in front of me.
Surprising, they just look like regular computers.
Okay.
You know, this is news to me. I do track the ETF space really closely, and some of the shiniest objects out there are some of these quantum ETFs. There's one from Defiance, the Defiance Quantum ETF. The ticker there is QTUM, and it's really ballooned over the past couple years. So the investor interest in there, this ETF is up to $2.6 billion in AUM for what is still a pretty niche area of the market.
Absolutely. I mean, super niche, but people are really starting to see a lot of activity here. I mean, if you look at the trade here, you're definitely seeing a lot of green across your screen if you were to look at what the performance has been so far this week.
So far this week and so far this year, again, taking a look at that ETF, which tracks all these names in the quantum space, it's up 35% year to date, which I guess compared to gold miners is just about nothing, but still exciting. Norah, Mulinda, great reporting as always. That is Bloomberg's Norah.
Are you
Mulinda.
referencing the relentless rally that we've seen in gold price?
Crazy.
You know, every day I wake up, I just send Joe Weisenthal a message because he used to make fun of me for being a gold bug back in the day.
You
know,
actually, yeah. That tracks that you would be a gold bug, or a bond investor. They have.
Okay, I don't know if that's a compliment or an
no,
insult,
it is,
but okay.
It is. That's supposedly the smart money. Anyway, coming up, we'll take you to the closing bell with Kristina Hooper. She is chief market strategist over at Man Group. That conversation coming up next. This is The Close on Bloomberg.
Breaking news crossing the Bloomberg terminal, Hamas is saying that it has agreed to release all Israeli hostages. A statement coming out of Hamas just now in response to the plan that President Trump and Benjamin Netanyahu had put on the table earlier this week, saying that they are, quote, ready for immediate talks on the Gaza plan details. Hamas also says that it appreciates Trump's effort to end the war in Gaza, but probably the big headline, certainly for those families and friends of those still being held, Hamas is saying that it has agreed to release all Israeli hostages.
We will continue to follow this story. Take a look at markets right now. Not too much reaction, of course. We are heading to the close on this Friday. Just 10 minutes to go. You can see the S&P 500 trying to hold on to its gains, up just about 0.1% if you're optimistic and round up a little bit. Big tech doing its best to drag us down right now with the Nasdaq 100 down about 0.4%. No haven bid into bonds. You can see that yields rising at the long end slightly here as small caps run away with it. The Russell 2000 up about 0.8%, Romaine.
We should point out volume in the bond market is light, about even in the equities space, as the market now basically left to its own devices to sort of parse through the private data with the government shutdown and push ahead to what's going to be in about a couple of weeks the start of a new earnings season. Kristina Hooper joins us right now to count us down to the closing bells, chief market strategist at Man Group. Kristina, great to see you.
Great to see you, Romaine.
I want to talk about the rally, and ostensibly, no matter how it shakes out today, we're more or less at record highs across the board for all of the major indices. And there are a lot of people questioning why. There are a lot of people questioning whether there's still more left in the tank for stocks to go, or whether we should maybe start to prepare ourselves for a meaningful pullback.
So I think we can do both at the same time. There could very well be more in the tank because so much of this rally has been driven by AI CapEx, and that could very well continue. If we look at projections for the third quarter, the Mag 7 have a much, much higher earnings growth rate than the rest of the S&P 500. And so a lot is being banked on one factor. So I think, as Chuck Prince said in the global financial crisis, you keep on dancing while the music is playing. I'm paraphrasing that, and obviously not a great time to harken back to. But I think you can do that at the same time you're preparing. So, for example, you're making sure that you're not overweight, you've taken profits, and you've diversified. There are opportunities in China tech with lower valuations. So you can do two at once.
There's been, just looking a little more short term, there has been some concern that we might see more muted activity for the rest of the year, given the outsized gains that a lot of investors are sitting on. The idea that why take risk into the last 3 months of the year if you don't really have to? Maybe you ride it out. Are you seeing any sort of evidence of that, or are people still just, in this sort of fear of missing out euphoria stage?
I think it's more fear of missing out, but hedging. So I think that's why we've seen such a strong gold rally. That is a hedge against a number of different risks. At the same time, that investors are still very much in the thick of U.S. tech.
In the thick of U.S. tech, but we keep hearing about this potential broadening out that's happening within tech, that it's not just about the AI trade expressed through, of course, hardware, through chips, the picks and shovels of AI, that there's this broadening out into other applications and into software as well. Do you think that it's time, or do you think that that could be premature?
I certainly think it's time. There are going to be areas that are benefiting, that we're going to see, additional CapEx spending. But keep in mind, we do have this overhang right now of economic policy uncertainty, and it's pretty significant. It's come through in a lot of the different surveys, whether it's the ISM surveys or the Federal Reserve Beige Book. So we have to recognize that that is going to a certain extent, cap the amount of capital spending that is going on by businesses. But certainly those areas like AI and AI-related expenditures are likely to continue.
That's interesting, because I feel like it's always a struggle to translate the soft data, some of those survey-based measures, like the Beige Book, for example, which is made up of anecdotes, into hard data, into actual business decisions. So how do you approach basically drawing that line between the two?
Well, I think you can get a lot of early indicators of what's going to happen from the anecdotal comments that are in the Federal Reserve Beige Book, in the ISM. Certainly, for example, we're seeing consumer confidence come down. That comes after months of comments, trepidation around consumers. That's becoming more evident now in absolute surveys. Now, has it translated into retail sales disappointment? Not yet. But I think that's a story of income inequality.
So when we see like the data today, like we got on ISM services, I mean, that was alarming to people. We know manufacturing has been in contraction for, God knows when. But the idea that consumer spending has, at least for now, held up. Based on what we know. And obviously we know in terms of business spending, certainly in the tech space, that is on fire right now. How does that weigh out in terms of what the economic impact is? Is the consumer spending and that CapEx spending that we're seeing in the business, is that going to be enough to sort of keep us going?
I think that's a huge question mark right now. I think for now it has been. But what we could see is some chipping away at that strength. All we need to see is, for example, more white-collar layoffs, and then more of the middle to upper income consumers are going to reduce their spending. The very high-income households will likely continue to spend. They're incredibly sensitive to the stock market. So as long as the stock market's going up, I think they'll keep spending. But it's a question of, how much erosion will you see before the economy really deteriorates?
Well, I think that brings us nicely to a discussion on the shutdown that we're seeing right now, because a new element in this conversation around the shutdown is that it's not just furloughs we're talking about, it's potentially mass layoffs. So you mentioned, of course, potential job losses when it comes to white-collar workers. But if we saw these layoffs materialize, and you think about the long-term effect that has on the economy, I mean, where do you fall on that debate?
So I think there aren't that many government workers. I mean, if we look over history, we're at a relatively low level. I think it's going to be hard to fire a lot of them without impacting some significant services that are important to most voters. But having said that, of course, that adds to what I think is already going to be significant increase in unemployment from those federal workers that have already been laid off. That wasn't supposed to hit until like September or October in terms of the payrolls.
Kristina, great stuff. Always wonderful to talk to you. Kristina Hooper, Chief Market Strategist over at Man Group. Now, we are counting you down to the closing bells, but we do need to get back to that breaking news. A statement coming out of the group Hamas, of course, which had represented the Palestinian territories in Israel, saying that they are tentatively agreeing to some of the contours of the peace plan laid out by President Trump and Benjamin Netanyahu earlier this week. And I just want to be very clear about the language here. They are saying that they are prepared for a full withdrawal and cessation of activity in the Gaza Strip, a release of all Israeli prisoners, both living and deceased, but that would be in accordance with the exchange formula outlined in that proposal, which is contingent on the field conditions and carrying out of the exchange. So some very precise language in here. We are seeing some activity right now in the Israeli shekel, strengthening against the dollar by the most in quite some time. We're going to get you some more details and bring you that as soon as we can. In the meantime, we count you down to the closing bells.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Katie Greifeld, taking you through to that closing bell with the global simulcast. Carol Massar and Tim Stenovic join us in the radio booth. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube, an eye on the markets, an eye on Washington, and an eye around the world today, Carol.
Yeah, absolutely. Something that you guys, I know, have been breaking down. We too, as it's crossed the Bloomberg terminal, about Hamas saying it has agreed to release all Israeli hostages, both alive and deceased. A statement responding to the U.S. plan to end the ongoing conflict in Gaza. We've seen a firming of the shekel. We've seen oil prices certainly moving off their highs of this session. But, you know, geopolitics have certainly been top of mind for investors, not just this year, but for the last several years.
Hamas, though, also saying that other parts of the president's 20-point plan, this was released on Monday afternoon ahead of the comments from Prime Minister Benjamin Netanyahu and President Trump in Washington, D.C. That plan, quote, require a unified national stance and must be addressed based on relevant international laws and resolutions. So Hamas agreeing to some of these terms outlined in the 20-point plan ahead of this deadline on Sunday.
Well, to that point, Tim, Hamas also added that a peace plan will be discussed within a comprehensive Palestinian framework here. But it is interesting to get these details coming off of that news that we got on Monday. That was the big question. What was the response going to be from Hamas? And at least now we're getting some of these details here.
And of course, the other big story that we are watching outside of Wall Street, but that could have implications, is the government shutdown in Washington. We just learned a little while ago from Bloomberg government that the House Speaker Mike Johnson has basically designated next week as a district work period, which means that representatives will not return to Washington next week. We are told the Senate Democrats do plan to return. Remember, it's the Senate right now that would have to vote in that bill. But if they were to pass that bill, of course, you would need the House back here to reconcile some of those issues. So a potential for this government shutdown to drag on just a little bit longer. At least for right now, the market kind of shrugging it off. The NASDAQ Composite and NASDAQ 100 are going to end the day in the red. The S&P 500, it's only up, well, less than a point, but as record highs go, as it had a record high today, green on the screen means record high again today. The Dow Jones Industrial Average also closing out the day at a record high. And I want to take a look at the Russell 2000, an 18-point gain on the day, 0.7%. The small caps, led by a lot of those quantum computing stocks, pushing the Russell 2000 back to a record high.
You know, you have those days where you just don't have enough Bloomberg screens, and we have a lot of them. This is one of those days for me as well. All right, back to the big caps. S&P 500, folks. Most names actually in the index, so more of a bullish tone, if you will. 322 names, Katie, higher in the Friday's trade and 179 to the downside.
Similar story if you take a look at the sectors here. What was your big winner on the day actually was healthcare. We know it's been a phenomenal week for that sector as a whole, continuing on this Friday. It's exciting to say that tech was actually down today for the last several days. Of course, on the right of your screen, information technology has been green. That hasn't been the case today, down about 0.3% as a sector. But even still, more winners than losers, and the S&P 500, Carol, just barely finishing in the green.
All right, guys, let's go to some of the individual gainers. U.S. rare earth, ticker USAR, soaring, hit an all-time high in today's session, 24% higher at its best levels of the session, finishing the close with about a 14% gain. This coming after CNBC reported that the company is in close communications with the Trump administration. When asked whether the company would be open to a deal with the U.S. government, we know that the government here in the U.S. has taken stakes in rare earths company MP Materials and miner Lithium Americas. The U.S. Rare Earth CEO Barbara Humpton supporting these government stake deals, according to CNBC. That stock 130% higher here in 2025. About 11% of the float is short. We just
spoke to Barbara Humpton.
She was still at Siemens. This was just a little while ago, a week and a half ago.
Yeah, she just started this week at the new company.
Yeah, so interesting. We'll have to check in with her again. Reddit rallying at its best levels, up 6%, finishing with a gain of more than 3%. Analysts expressing confidence in the company's revenue. As of Thursday's close, though, the stock has shed about 26% since peaking in mid-September, including a tumble earlier this week due to concerns about a drop in OpenAI citations. Now, keep in mind the ALS community, a lot of them coming out. Oppenheimer has an outperform rating, and they say, we believe certain third-party data providers indicating reduced ChatGPT Gemini usage of Reddit data in September is a measurement issue and not reflective of actual user or LLM behavior. So that was Oppenheimer, but a lot of other analysts, similar messages. Rumble, thank you, Tim, for this one, up about 16% in today's session. The video platform and cloud services provider rallying after entering into a strategic partnership with Perplexity to develop a new subscription model, combining the pro features of each platform. I feel like I'm speaking a foreign language. Stock is down about 35% year to date. 20% of the float is short.
Don't worry. It's a big TAM there.
Yeah.
The ARPU.
The ARPU.
There we go.
I love some ARPU. Okay.
All right. Let's get on over to some of the decliners today. I want to start with Palantir. This was the biggest decliner on a percentage basis in the S&P 500, down 7.5%. It actually fell about 8.7% earlier in the session. This following a Reuters report that its battlefield communication system was seriously flawed. Palantir and Anduril came out with a statement after that and said the issues in the report were out of date and inaccurate, and that the systems had already been addressed that didn't do much to change the direction of the trade today, at least when it came to Palantir shares. Reports down 7.5%. Palantir stock down 7.5%. Also, Roblox shares down more than 8% today. Shares fell the most intraday since August, after an analyst at M Science came out and said that U.S. bookings growth has decelerated sharply from recent highs. That said, Corey Barrett expects bookings growth to remain, quote, at or near recent highs in non-core markets, ex-US and Western Europe. And finally, watching shares of casino companies, gaming companies that have a large presence in Macau. Wynn Resorts, Las Vegas Sands, both falling more than 7% today. Citi says national passenger data from China's travel ministry for the first 2 days of Golden Week was weaker than expected. Wynn gets about 51% of its revenue from its Macau operations. Las Vegas Sands gets about 62% of its revenue from Macau.
All right, let's take a quick look at yields here. We actually did see yields actually rise today, second straight day. Of course, this is coming off of what we had seen over the previous days where it had been in the opposite direction. We should point out on a weekly basis, we're still looking at a two-year yield lower than where it was 1 week ago today, 3.573 and change. That's where we stand right now heading into next week, guys.
All right, guys, let's get to some of the interesting stories on our radar. And we talk, obviously ongoing about inflation and where we still continue to see pressures. Well, global meat prices extending a rally to a record on tight beef supply. So global meat prices, as I said, a fresh record in September to the longest run of monthly gains since 2021, Tim.
Yeah, the index tracking meat commodity costs rose 0.7%. Meat was the only main food commodity group tracked to increase in September, also supported by higher sheep meat prices. Got a few issues facing the U.S. right now. We have a smaller number of cattle, actually, but also we import a lot of beef from around the world, specifically from Brazil. But remember those 40% tariffs that the president slapped on Brazil just in the last month or so? That affects the price of that coming in.
I see these pictures of cows and it makes me not want to eat.
You know what you can do, though? I mean, if you're having a little trouble affording meat, you can stretch it out with sauces, guys. I saw this story today that apparently the U.S. has been taken over by sauce. The U.S. condiments category is now at $12 billion. That's a 50% jump from where it was just prior to the pandemic. Basically, everyone likes to put sauce on everything. And by everyone, I mean everyone but me.
You don't like it, sauce?
No. I don't like sauce either. I like, just some salt. That's it.
Yeah.
Salt?
Yeah.
Salt, pepper. Keep it simple.
It works. It works. I will say, I can't believe that no one said that there's a bull market in beef right now. I feel like that was a really easy joke.
Are you saying we're stupid?
No, I'm just saying it was right there for the taking.
We were letting it, we're letting it go for you.
What kind of sauce does Carol Master?
Bernaise.
Bernaise, okay.
Fancy.
You know what?
I still remember the first time I ever took her out to dinner and she ordered, what was it, the escargot? What was the thing you ordered?
Probably
I don't know.
escargot.
It was something expensive.
You know what?
Snails, that's all I know.
I'm still waiting for the first time Romaine takes me out.
It was like snails and champagne.
Yeah.
Wow.
Tim, do you eat?
I do, yeah.
I walk by your desk every day.
Do you want to know what Tim had for lunch today? It was good. It was
beets
personal. And tofu.
This is personal.
Well, now everyone
Can I just tell you guys?
And now you know why I haven't asked you out for dinner.
You want to know if he eats? His empty food dish is right here in the studio.
Listen,
every day.
Because you asked, I'm more of a hot sauce person. More of a hot sauce person.
You are?
Yeah, and the trick is you don't need to put them in the refrigerator. It actually tastes better if you keep them out of the refrigerator.
I like hot sauce.
Yeah, so maybe a little Cholula, Valentina.
You guys can go on hot ones.
Yeah,
hot sauce in your
that would be fun.
That would be fun.
I would make it to like the second wing. That's it.
Crying from your eyeballs.
I absolutely would be sweating profusely.
Great.
Yeah. Here's a pro tip. If you ever go to Southeast Asia and they ask you if you want it spicy, say no.
Say no.
You need to stop talking because
I learned that the hard way.
That for not wrapping this. All right.
I'm still waiting for Romaine to take me out to dinner.
Don't hold your breath. No, just kidding. Have a good weekend, guys.
It's time for us to move over.
Oh, gosh.
Okay.
All right, goodbye. See yourself out, please.
All right, that is a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals. Katie and Romaine continuing there on the close. Tim and I right here on Bloomberg Business Week Daily. We will see you again, same time, same place on Monday.
And our coverage continues here on Bloomberg Television with public markets closed for the day and the week. Let's push ahead to what's going on in private markets, the intersection of the two. That conversation after the break with Jared Gross, head of institutional portfolio strategy at JP Morgan Asset Management. This is The Close on Bloomberg. Welcome back. We do want to go back to that breaking news, Katie. This on Hamas apparently agreeing to some of the terms from Trump's peace deal, a way to end the war in Gaza. We want to go right out to our foreign policy reporter in Washington, D.C., Eric Martin, who's been keeping tabs on what's going on. Eric, there's a very pointed statement here that seems like it includes a lot of conditions, but the contours of it does seem to suggest that Hamas is willing to turn over all of the Israeli hostages, both those alive and deceased, and move towards some sort of formal agreement to end the fighting in Gaza. What do we know?
That's right, Romaine. What we see from this statement so far, President Trump had given Hamas until Sunday at 6 p.m. to give an answer to his 20-point plan. What we've received here in the last few minutes is a statement from Hamas saying that they are willing to give up all of the hostages, both living and dead, which has been a big priority for President Trump. But what we're not seeing, which is perhaps equally important, is an acceptance of all of the 20 points on the plan that was unveiled on Monday by President Trump alongside Prime Minister Netanyahu. And so that's going to be key to seeing what the U.S. response is now. The idea that some of these points, which we've talked to experts who have said certain things like Hamas agreeing to unilateral disarmament, might be very difficult for Hamas on the ground in Gaza to accept. And so looking to see what those discussions look like, where the two sides remain apart, and what they might be able to come to agreement on there in terms of a path forward.
Right. And when it comes to the path forward for the Gaza Strip, talk to us a little bit about that, because reading through some of the details here, Hamas says that regarding those other matters, that a unified national stance is needed to address any relevant issues regarding the future of the Strip. What does a unified national stance mean in this context?
Well, that's a great question. There's been an open question about who will govern in Gaza after the war. I was a couple of weeks ago in Jerusalem with Secretary of State Marco Rubio and with Prime Minister Netanyahu, and I asked them both about the planned Israeli offensive since August to go into Gaza City. And what both had indicated was that they were hoping there would be a way to bring the war to an end, for Hamas to give up the hostages without that having to happen in terms of that potentially devastating operation. But for Israel, it's key that this October 7, 2023 terrorist attack, 1,200 people killed, many more taken hostage, that this never could be repeated. And so whether that is the Palestinian Authority, which there's been some skepticism, certainly for Israel, not acceptable for Hamas to remain in power. That's a key question for us going forward.
Eric Martin, our foreign policy reporter down in Washington, D.C., a developing story. We're getting one side of it today, and we'll continue to monitor to see if we get a response out of either Israel or the United States as well. Katie?
Well, let's switch gears here, because Bloomberg News is reporting that Blackstone, Carlyle, Apollo, and Blue Owl are among the Wall Street firms that are talking with mutual fund companies about finding a way to add private credit and potentially private equity to some existing target date funds. Now, remember, those are the premixed portfolios that have become a mainstay in 401k plans. And while it's easy to see the appeal for private asset managers, questions remain about whether less liquid and sometimes riskier products belong in those retirement plans. Joining us now to discuss is Jared Gross. He is head of institutional portfolio strategy over at JP Morgan Asset Management. Joining us on set. Great to see you, Jared.
Thank you very much for having me. And your lead-in, I think, set this up really nicely. This is the key question today, which is, should participants in 401k plans have access to private investments, private equity, private credit? You know, they obviously have clear benefits over long horizons as an investment tool, but they also bring with them higher fees, less transparency, and illiquidity. And so for the plan sponsors, who are ultimately responsible for making these decisions, it is a difficult choice. And so we recently published a paper on this topic that's, I think, trying to come down in a balanced way on both sides and explain to the sponsor community how they can move forward productively, because I think at the end of the day, if we can find a good way to get private markets into retirement pools, the benefits will be profound.
It's interesting, to hear you talk to both sides of this issue. And I feel like a lot of this comes down to allocation, whether we're talking about 50%, whether we're talking about 10%, depending on the sizing that we're talking about in a portfolio, it's a different answer.
Yes, 50% would be alarmingly high. I think it's useful to look at the examples of other types of investors who use alternative assets at scale. You think about defined benefit pension plans, public plans, university endowments, and so forth. They typically operate maybe somewhere between 15 and 30% of their assets in alternatives broadly defined. And they also devote a lot of resources to doing this well. It is not as simple as just calling up your, kind of asset manager and saying, I want to shift my capital around, particularly for the plan sponsors who operate within a regulatory environment that requires them to have a very disciplined, very transparent process that shows clearly that this is for the benefit of the participants. Mm-hmm. And so, we think that within a target date fund, which I agree, with your intro, is probably the most likely path forward for most DC plans, a sleeve of diversified alternatives that may get up towards the 20% level is probably the right thing.
First of all, I'm glad you liked her intro, because she spent a long time writing that today. So kudos to Katie there.
Thank you.
Sure thing. In all seriousness, though, I am curious just about the diversification benefits, particularly in light that there seems to be some concern that given how much the alt space has grown, that there's a little bit more correlation, if you will, with public markets now. So if we start to see this stuff show up as an option in some of our retirement plans, how much certainty or transparency is there going to be about whether this is truly adding diversification?
I think it depends a little bit on what type of alternative asset class you're talking about. So if you look at historical returns, and we should just footnote this, historical performance in most of these asset classes has been terrific, and it has come with very low volatility. So we have to be at least mindful that on a forward-looking basis, we might see a different pattern of return and risk that we have not seen previously. So, a little bit of humility is needed here. But, private equity historically has delivered modest diversification benefits, higher returns, and relatively modest income. If you look at private credit, historically has delivered much higher levels of income, although often within closed-end funds where you don't necessarily receive it immediately. And I'd say reasonable diversification, although, again, credit tends to correlate with equities. Where you really find the diversification is in real estate, infrastructure, and other real assets, which have much lower correlation to the equity market broadly, where most of the remaining portfolio risk lives.
And some of that, a lot of us, we've already had some degree of access to, at least on the real estate and the hard asset sides. When it comes to private credit, and for that matter, private equity as well, in a target date fund, is this something that you think you can envision advisors sort of pushing more towards younger people who have a much longer time frame between now and their retirement? Or is this something where you can maybe see a meaningful allocation in somebody who's maybe in their, say, 50s?
I think you can make a case for some form of alternatives across the full life cycle. So the term of art in the target date fund business is sort of the glide path, which represents this gradual de-risking from the younger years where someone has a very long investment horizon and a greater risk appetite. That's where you would expect to see private equity. I'm not sure if venture capital would ultimately wind up in this space, but assets like that. And then as the portfolio builds in size, the value of diversification grows. Even if it's too premature to de-risk significantly, the diversification itself has real value when you have a larger pool of assets. And so we would expect to see glide paths pivot from more equity focused to more credit focused. And then as you get closer to retirement, income driven strategies. And one of the benefits of real assets, whether you're talking about real estate or infrastructure, is inflation resilience. And more defined contribution plans are keeping participants in after retirement. And so as an income stream, it's not unreasonable to think that some of these alternative assets could actually stay on beyond that point.
I want to talk about a point that you make in the notes that you sent over to our producers, that private markets now represent an increasingly large portion of economic activity. And I would love to talk about how that's just evolved over the past couple of years, because there's a lot of ink that's been spilled about the fact that, a lot of the most exciting companies are staying private. They can get all the funding they need there. And then you take a look at what's going on in debt markets, and issuers are going back and forth between the public and private spheres. But it seems like that has really become accelerated just in the past couple of years.
Well, I think that's exactly right. So first, look at it from the perspective of the investor here, the retiree, or the individual who's saving. Restricting them from having any access to these sort of engines of economic value creation is, suboptimal. Now, public markets can still do a very adequate job, and maybe more than adequate, of delivering long-term returns that investors need to accumulate wealth and retire. So for those, defined contribution plans that are focused on the public markets, it's not clear that they are really sacrificing a significant amount of potential return. But I think over time, as more and more activity does happen in the private markets, removing that is increasingly problematic. And yeah, this has been going on for a long time. I mean, one of the things that we do a lot of work on at JP Morgan Asset Management is this convergence idea that, when you look at the markets, you're looking at, lending activity. There's a lot of similarities, whether that's taking place on a bank's balance sheet, in a private credit fund, through the broadly syndicated loan market, the high yield market. And a lot of the risks are similar, but investors in those different vehicles will experience those risks in very different ways. And that's something that I think investors today, I've seen a lot of the headlines go by around private credit and where it stands as an asset class. And I think people are really focused on this because if we are heading towards an economic downturn, if we are seeing the level of compensation for credit risk getting squeezed as spreads get tighter and tighter, it's not, we should expect to see that risk percolate up in all of these parts of the market, not just the public markets.
Yeah, well, to that point, spreads certainly at some breathtaking levels. Jared, great to get some time with you. Have a great weekend when you get there. That is Jared Gross. He is head of institutional portfolio strategy over at JP Morgan Asset Management. Now, coming up, happy Taylor Swift album release day to all who celebrate. We'll talk to the author of Swiftonomics.
When does that come out?
That came out at midnight, Ramin.
Oh, okay.
Yeah, don't worry. I listened to it. I'll tell you all about it. We'll talk to Misty Heggeness about that. Plus, we'll talk to Detavio Samuels. He is the CEO of Revolt and Offscript, about the changing media landscape and the creator economy. Don't want to miss those conversations. Coming up next, this is Bloomberg. And now, are you ready for it? Today, Taylor Swift released her 12th studio album, The Life of a Showgirl, along with a limited run release party in movie theaters this weekend. Swift is now worth more than $2 billion, a sum that's sure to grow after this weekend. Joining us now to discuss is the author of Swiftonomics, How Women Mastermind and Redefine Our Economy, Misty Heggeness. She's also an associate professor at the University of Kansas. So, Misty, we could talk about the album itself probably through the end of this show, but let's talk a little bit about Taylor Swift and how she has become this business mastermind, as you put it. My opinion was that she could have waited another year to put this out. She could have marinated in her feelings a little bit more. But you think about her relationship with her fans, for example, and they're used to sort of this content that she reliably produces, and they're willing to pay up for it.
Yeah, I think that's totally true. Thanks for having me, by the way. She has really curated a hardcore, dedicated set of fans, and, they're used to her reflecting and then producing kind of immediately. And so I think for the fans, this was a great treat.
And talk to us, too, about the element of the fact that, there is this release party. You can go and see it in theaters. That's one way that she touches them. Another way, of course, to bring in a revenue stream. You can find that, with the merch opportunities. Obviously, she's coming off of one of the most successful tours of all time. It seems like there's all these different touch points to her audience.
Yeah, there is. And it's really fun to watch. She is really creative with her art, and she's also a very creative marketer. So you know, she continues to push the envelope on what singers and what musicians can do and how they can engage with their audiences. I love that this time around, there's not only a listening experience, but also a visual experience in the theaters. And, you know, she connects really deeply to her fans. And I think, you know, part of her goal is to give them opportunities to be together and experience.
How do you assess, Misty, her staying power beyond this? I mean, she's obviously been at this for a couple of decades now. And when we talk about the life of any real entertainer, certainly a pop star, it's usually a lot shorter than a couple of decades. Does she branch out into something else? I don't know if she can act. We had this conversation with Katie earlier. She was offended because I said I've never seen her act. But I mean, is there sort of something for her to do beyond this? Does she just become a business person, or is she just going to continue to put out albums and tour until you know, she reaches a certain age?
Yeah, I mean, so first of all, I'll say she definitely can act. If you watch some of her music videos, she's been in, you know, had a couple of visiting position, you know, spots in some movies and other TV series. So she can definitely act. You know, I liken her to a Madonna or a Dolly Parton. You know, women in the entertainment industry who have that level of talent can stick around for as long as they want.
Yeah, and I'm glad you bring those people up. And we talk about, obviously, certainly in part, an icon, and Madonna, an icon for a lot of folks as well. But then I always think about their career trajectories and how they branched out, I think, a little bit sooner than maybe what we're seeing with Taylor. And I don't know if that's maybe just a function of the time that we live in, particularly with, I guess, her own battles over her own catalog, reclaiming those the rights to that catalog, and now, of course, you know, putting on back-to-back 2 blockbuster tours. Although she didn't get the Super Bowl, Misty. Why not?
Well, you know, rumor on the street, I don't have any verification of this, but rumor on the street is that she declined the Super Bowl because they wouldn't give her complete control and ownership over the rights of the performance. But, you know, she's stuck around in this lane because it's been really successful for her. You know, why change a good thing if it's working for you? So I do think she will start to evolve, and her content will change a little bit as she continues to age.
We did forget one really important film credit of Taylor Swift. That, of course, is Cats. She was in that movie. It was a haunting performance.
Cats?
Certainly.
Wasn't that like one of the worst movies ever made?
I saw it in theaters. Last movie I saw in theaters before the pandemic.
How was her performance?
Fantastic.
Okay.
We don't have to go into it. Maybe we can grab some video of that. But in any case, let's talk a little bit more about where this goes for here. Because, Misty, so far the reception on social media to this album has been pretty negative, I have to say, even in Taylor Swift dedicated subreddits, which I have been on today while feverishly preparing for this show, and it seems really mixed. There is some disappointment out there, but then you think about the potential tour that could come out of this, and they're real productions. So I wonder, you know, how this album is being received has a bearing on her future tours, given that she has this body of work.
Yeah, I mean, who knows? TBD, I would say. You know, I think with this album, it is only 12 songs. The albums that she's been producing as of late, kind of since the pandemic, have had, you know, a second iteration. Who knows if we'll see that tonight or tomorrow. I think she still has some surprises in store for us. So, you know, I think we hold out until the end of the weekend to make a final determination. You know, and this one is more upbeat, so it's a little bit more lighthearted, and, you know, that could also be influencing the vibe.
All right, Misty, really great to have you here. It's always a fun conversation, and really, I mean, we poke fun here, but we've talked a lot here about her economic impact, not only in terms of her tours and what she brings to cities, but just obviously the idea of just really parlaying your fame as an entertainer into something much bigger, a business unto herself. Misty Heggeness is the author of Swiftonomics, How Women Mastermind and Redefine Our Economy. She's also an associate professor at the University of Kansas. Now, we do want to stay in the media and entertainment space, and we're going to go off script right now. Detavio Samuels is the CEO of Revolt and the newly launched parent company, Off Script. It's a creator-focused media platform that helps creators monetize their IP across multiple channels. And pleased to say that Detavio joins us right now here in Studio 2. Great to see you, man.
It's good to see you. Thank you for having me.
So I think the last time we talked, we talked a lot about, sort of people creating their own content, people who aren't Taylor Swift, just regular old people who are trying to find a platform here. Now, explain kind of I don't know if this is a rebrand, if that's the best way to call it, but you're turning Revolt into something that's a little bit bigger and a little bit broader. Just kind of explain the strategy behind that.
Yeah, sure. So the way that I look at it is Revolt was the proof point. For the last few years, we've been building an incredible media company powered by some of the best creators on the planet. The shift to Offscript and the parent brand of Offscript is essentially to say that we are now shifting to the holding company for the dopest creators, the coolest creators who move and shape culture, powered by a world-class media ecosystem. And so we are not just a media company anymore. We're not a talent agency. I would say that we are the only vertically integrated full stack company that's focused on helping creators go do everything from make content to distribute content to monetizing that content.
Where are these people coming from? Are you seeking them out? Are they coming to you?
Yeah, so we have a full team of people who spend all day long looking for those people who shift and move and shape culture. And the same way you would have seen music labels who have A&Rs, that's what we have inside. And so I would say our core focus is looking for those creators who are anchored in a YouTube platform. YouTube is the #1 place where you get attention. It is the #1 streaming platform in the world, and so very much anchored in that, but open to creators no matter where they come from and no matter where the anchor or the core of their work is present.
That's exactly where I wanted to go, because I find the discussion of the different social media platforms that are out there, it's really interesting. And this is a conversation we've had before with the likes of Gary Vaynerchuk, for example, that, what works on YouTube isn't necessarily going to work on TikTok, isn't necessarily going to work on a text-based platform such as X or the like. So YouTube, it sounds like, YouTube is eating everything, and that's where you want to be as well.
Yeah, look, I think that social is the #1 platform that matters. It's where all of the world's attention is. So often you're finding these people because they are popping or doing something really incredible in social. But when it comes to how can you help monetize them, how can you build them, do they have real proof points that they can create long-form content that can sustain attention? YouTube is that space. When you look at where people are consuming content, the #1 place they're doing it is streaming. And then when you look at it, whether it's streaming Netflix, Disney, Hulu, the #1 platform is YouTube. And so that's where our focus really has been.
That's really interesting, because I feel like I just gravitate towards these short-term videos, and I would like to not do that for what it's worth, but it is addicting. So to hear what you're saying, that you prioritize people who can create that long-form content, how do you view those short-term content creators, such as TikTok, such as Instagram Reels?
Yeah, it's mission critical to me. Like, I don't think that you don't exist today if you don't have a presence in social. Like, all of us are finding and discovering every single thing that we do in social. But then once you have that unlocked, the question is, can you move them to a platform where you can capture their attention for 10 minutes, 20 minutes, 60 minutes? And that's where we start to focus on YouTube.
Well, first of all, on the social, I have a couple questions on that. I mean, how reliable is social media these days? It seems way more fragmented. There's been a lot of discussion that it's not driving eyeballs and traffic in the same way that it was doing a few years ago.
Yeah, it's difficult without question, and that's why when I talk about like our anchor and our lens, I talk about those who move and shape culture. You're looking for those people who have influence and can move an audience. And so social is reliable. Everybody, the people, everyone is on social. The question is, who can carry somebody from TikTok to another platform? These social ecosystems are built to be embedded worlds to keep you in those spaces. And so the creators who can not only capture attention there, but then prove that they can move you somewhere else, those are the ones that are highly valuable.
I mean, give me some examples. I mean, not necessarily just your clients, but people that you look at and you think they're doing this right.
Yeah, I mean, I would love to use people from our ecosystem, because I think the people that we choose are incredible. One of my favorite creators right now, one of the biggest creators on our platform right now is Cameron. If you remember him from hip hop career. And so Cameron,
you remember Cameron, don't you?
You remember Cameron? And so Cameron is proving day in and day out that he is fire, that he can create momentum, create excitement in the world of social, but then he can also take you to YouTube and generate 1 million views views on an episode.
In all seriousness, though, I mean, we bring up Cameron. I mean, for those of us of a certain generation, Cameron and Dipset, that was like everything. But is he trading? Is he trading off of, I guess, his old fame from those heydays, or is it just his personality, what he does now? And also, I am curious with regards to his personality. And I follow Cameron a lot, so I'm going to be delicate how I said that. But is it also just about being inflammatory and just trying to stir up trouble?
No. So the reason I bring up Cameron is because I think he is such a special creative. So you think about it today, when you look at YouTube, one of the biggest things that makes people pop when you talk about talk shows is who they're talking to, who's the other person on the other side of the camera. Cameron shows, half of his shows, he has no guests. Him by himself is single-handedly able to entertain audiences for an hour, 2 hours, and again, generate 1 million views. That's special. Two, when you look at his talk show, it's just not a normal talk show. Cameron's shows will do everything from interviewing himself to a rap battle to a dance competition. Like, he's playing and he's having fun. The last piece that I'll just say is one of our biggest bets is not just creators who can prove that they can create a show. We're super focused on what I would call like creator CEOs or creator studios, people who can prove that they can generate show after show after show. Cameron has an incredible library of hip-hop cult classics and movies. He's working on movies today. He's working on television shows. And so this is the perfect type of person that we like to partner with at Offscript, because at the end of the day, our goal is to figure out how to take these creators from a singular show into the media platforms that they desire to create.
So diversification and staying power, it sounds like those are things that you value. But to that point, I mean, how do you measure success? Is it as simple as clicks, views, et cetera, the metrics that you would look at? Or, you know, what other measures do you use to assess?
Yeah, so again, for us, it's always going to start in social. Can you break through and find people there? Two, then it's going to move to YouTube. It used to be on YouTube, a great creator was able to do 1 million views in 24 hours. Now, you're lucky to do 150, 200. So those creators who are doing episodes that are doing 300,000, Cameron's last 2 or 3 episodes are all 600,000 plus, right? So that thing matters. And then the last piece that I would say when we look at it is there's going to be an existing deal between us and the creator, but then it's going to be, to your point, how do we really generate ROI together? And so then the third piece we're looking for is how did we extend this creator into other platforms, into other channels where we can be great partners and make money together?
Well, when it comes to those other platforms, I mean, for right now, it feels like I have a pretty good grasp on all the places where people are. But I mean, how much of your time do you spend just scanning the horizon, trying to figure out what's going to be the next TikTok, for example, where the puck is going to move next?
Oh, so in terms of a platform, in terms of creative platform, I would say it's really hard to create a new platform. I think in general, right now, what you see in media is that there's a handful of giants that are winning. The streaming wars are one. Right now, it feels like the social media wars are one. And so what we would be on the lookout for is another platform that somehow found a way to pop and crack through all of the noise that's happening. But in general, my point of view right now is kind of the table is pretty set.
With regards to just the business model, is this still weighted towards advertising in terms of generating revenue? Is that
from an Offscript perspective? Yeah. So,
and where, I mean, how strong is that advertising environment right now?
Yeah, the advertising environment, like everything else this year, has been a little bit funky. But what we are seeing is advertisers have, you know, I think with all the changes that happened in the administration in January, February, advertisers were trying to get their footing. I think what we're seeing in the back half of the year is they feel much more stable, much more confident in terms of what's going on. And so we're seeing our business start to soar because of that.
Have you actually spoken to any larger media companies, or any of them reached out to you?
And for what?
Well, you know what I'm asking, in terms of partnership or maybe something more.
Yeah, so absolutely, because what we're trying to do is take our creators there. I don't mind partnering with I would love to partner with the Tubi. I would love to take Cameron and partner with a BET or a Netflix. Like, that is our goal. And so we don't see them as competition. We see them as peers, and we see them as great ways to help our creators extend their genius and show the world what they're capable of.
Well, let's definitely stay in touch. Great to get some time with you on this Friday. That is Detavio Samuels. He is CEO of Revolt and of Offscript.
All right, let's take a look at how markets closed here on the day. We talk about an S&P 500 that did manage to squeak out another weekly gain and a record high on the day. We should also point out, though, this was a market, once again, Katie Greifeld, driven by the AI trade, by the tech trade. That is what powered us higher, but there are a lot of concerns right now about whether that rally has been too narrow. A big concern, too, with the government shutdown, the lack of economic data, and what that means for the macro story.
Yeah, and you can see that SanDisk also at the individual level had a great week. DraftKings, a different story. This was a really interesting story to follow when it comes to prediction markets, sort of in turf, or coming onto the turf of the likes of DraftKings, dragging the shares down by about 16%.
Record week for stocks and also a record week for gold. Bitcoin getting its mojo back on this Friday as well. We'll be back in a moment. This is The Close on Bloomberg. Welcome back. Before we toast to the weekend, I want to bring you a conversation that I had alone, with Lisa Barlow. She's the founder of Vida Tequila. She's also, of course, a real housewife of Salt Lake City, and she spoke about working in the spirits industry for almost 20 years, and now she's expanding her liquor portfolio. And she talked about her role on Real Housewives and how that's helped her grow her business. Take a listen.
So we started in 2003 working on the brand. Launch in 2007 at the Sundance Film Festival. We did 10 days of amazing parties, and we've been doing it ever since.
Yeah, I mean, your background is in planning and marketing. And I'm curious, I mean, you talk about how tequila was kind of looked down on. It was kind of just, the drink, you had in college. And once you grew up, you kind of evolved. But we've seen tequila now have this sort of renaissance as being something that's a little more elevated, a little bit more sophisticated. That had to be, a big part of that was certainly marketing. And I'm curious as to what approach you took with Vida in doing that.
That's a great question. So I knew we couldn't compete with billion-dollar brands, so we had to be creative on our approach to market. So with my marketing background and my drive, I created my own marketing company to do experiential marketing events. I partnered in film. I have a lot of clients in film and TV, and I was launching TV shows, movies, and making sure my brand was front and center at all of those events. So it gives you a chance to create a trial of the brand awareness, and really marketing dollars. And, competing against billion-dollar brands where when we launched, one of the very popular brands was spending $25 million on print advertising alone. I knew I had to be creative, clever, and take a unique approach to market.
It's one thing to sort of shoot through and sort of, create some buzz for yourself, but to maintain that over, 18, almost 20 years now.
Yeah, almost 20 years.
Like, how do you do that? Because, I mean, there are so many tequila brands out there now, a lot of them also helmed by celebrities. So how do you sort of keep awareness about what you're doing?
I think the thing is you have to be constantly in front of the consumer, know your audience, know how to market to your audience, pick the right events, pick the right charities, be in the right places. I have a great Rolodex, and I've earned that over years. And because of that, I've been able to have my brand at so many impactful, meaningful events. And now with Housewives, I think it's like, I'm the celebrity now. I've always been on the back side of everything, and now I'm, front and center with the brand, and I think that really helps too.
As Housewives.
But I have the street cred with
you do have the street
true
cred.
Tequila fans,
You got the Andy Cohen cred too.
I got the Andy Cohen cred.
I assume that's helped as well, right, in terms of visibility for you?
For visibility, I think it's been great.
What do you want to do, like, going forward? I mean, you have your brands, you have the umbrella company above it. Is the idea to expand into other things, or just to push deeper into what you're already doing?
Expanding is always the goal. So we also have a hard seltzer named Blue Jay Hard Seltzer. We sell primarily in Utah right now, testing the market to see if it has legs, how well we'll do.
Now, forgive me if this is an ignorant question, but you're selling hard seltzer in Utah. That's a business model?
That's a business model.
All right.
Utah is high up on the drinking and innovative for drinks, beverage, the hospitality industry. So we're testing that market right now, and based on how well it does in Utah, we'll take it to other markets. It's an inspired drink off of Vida. It doesn't have any tequila in it. It's a sugar beet-based product. Super delicious, only 5% for those that are sober curious, or after millennials put together this whole sober movement and sober curious moment. So we've really tapped into that by having a lower alcohol-proof product, and then having our tequila brand, which is kind of the inspiration for the hard seltzer too.
I do want to ask how you utilize social media, particularly at a time when social media is becoming a little bit more fractured. There's a lot of questions as to whether it still has that same power to really launch and sustain brands that it did in the past.
I don't think social media is going away anytime soon, but it doesn't have the same power that it did 5 years ago, even 3 years ago. So I think one thing that we did is we opened a Vida Tequila Lounge in Hotspot, Park City, where I can be there to customer face, fan face, give them a trial of our tequila, sell them a trial of tequila, because in Utah you can't give away drinks. But, to really encourage, like, hey, this is like a trial of the brand. You can taste it with me. You can be here with me. You can pair it with me. And that's been really, really helpful. I love being in our lounge and being able to meet fans and also meet consumers that really love tequila, which is the fastest growing spirit category right now. Like, I mean, the increase in year-over-year growth is unbelievable.
A great conversation there with Lisa Barlow, the founder of Vida Tequila. I was sad to miss that conversation.
It was.
Truly.
We talked a lot. I learned a lot about tequila. I'm not a big tequila drinker, but she was talking about how, in her view, this is not medical advice, that it was actually one of the more healthier. If you're going to drink alcohol, that this is agave, I guess. Is that what it is?
Yeah, I think so. I mean, I would have to fact check you on that specifically on agave.
Well, don't fact check me. I don't know. But anyway, she was a very lovely person. And the tequila, I don't know if you're a big tequila drinker.
I love tequila in the form of margaritas, but I feel like you wouldn't put a good tequila into that. It would just be pointless.
Well, I don't know. You've never been to any of these fancy, cocktail bars in Europe now. They use the high-end tequilas now.
In the frozen
drinks.
margaritas that I get with salt.
I'm talking about like a real mixed string. Not,
Yeah.
Oh, you just get the little machine thing.
Oh yeah, I want it from the slushy machine. I want one for my house. Still ahead.
You can buy one of those,
Yeah, I'm trying.
It takes a lot to clean, though.
Trying to put it off for a few years, Anyway, we'll bring you through what investors need to watch for next week. Next, this is The Close on Bloomberg. Well, Goldman Sachs chairman and CEO David Solomon said he expects the U.S. economy to accelerate into 2026 during a conversation at Italian Tech Week with BTV's Tom McKenzie. Let's take a listen.
The U.S. economy is in pretty good shape, and there are some very, very strong tailwinds that have really had a profound effect, and there are also some things going on that are creating headwinds and are probably leading the economy to underperform its expectation at this time, but I'm optimistic that we're probably going to see an acceleration as we continue to head into 2026. The big structural issue that's kept the U.S. economy going so well is the U.S., and by the way, other developed economies around the world, are running very aggressive fiscal stimulus plays. Governments are spending enormously into economies in the developed world, and that keeps the economy going even when you have other headwinds. Second big macro phenomenon that's affecting the U.S. economy is all of the AI infrastructure build, all the capital spending, all that's going into the ground to support the deployment, the development, the continued growth of AI infrastructure into the enterprise, and that's a big tailwind too. That's balanced on the other side by the implementation of the trade policies, which are still getting absorbed. I think we're seeing, some of the effects from trade, but there's still more to go in terms of really understanding how the trade policy is fully implemented and how it balances growth. And then obviously the world's a little bit more geopolitically fragile, and that has an impact on growth and kind of confidence. But when you balance it all, and you saw the third quarter reading was quite strong, but year over year, from last December to this December, the overall growth trajectory will probably be a little bit less than 2%. And so that's slightly below trend, but still in pretty good shape.
And an acceleration into 2026?
I think that as the trade policies are absorbed and you have the continued stimulus and the continued kind of tech spend, you've got a pretty good tailwind.
Goldman Sachs chairman and CEO David Solomon there in conversation with Tom McKenzie. Tom McKenzie hitting him with questions from every angle there. All right, let's set you up for what could actually move the markets, Katie, over the next week. It's Friday, so let's push ahead to Monday, and we start off with, well, nothing. There's a U.S. government shutdown, so that continues, though we should point out the Supreme Court not affected by the shutdown. They are set to start their new term.
And we won't, of course, get any government data, but we will get some releases from corporate America, earnings coming from Constellation Brands, so something to chew into there.
Yeah, looking forward to that. We should point out the Greenwich Economic Forum taking place in Connecticut. Expected to hear from Ray Dalio as well as a few other folks there, and also a J.P. Morgan conference taking place as well.
Yeah, and apparently it's Amazon Prime Day again. So,
okay.
Yeah, something to look forward to. Then on Wednesday is Bloomberg Screen Time. I'm excited for this. Jimmy Kimmel will speak there, and that should be pretty interesting.
And don't forget David Ellison as well, scheduled to make an appearance too. So very timely topics. We are going to get minutes from the FOMC. More Fed speak. Muslim Bar scheduled to speak on Wednesday. And then on Thursday, Powell? Bowman? and Besson, all speaking at the Fed Community Bank Conference. Who you got?
Embarrassment of riches, probably Powell. We also get earnings from Pepsi and Delta.
And don't forget, Austin Goolsbee speaking on Friday, and a Nobel Peace Prize announcement as well. This is Bloomberg.